Hi, I'm Jimmy. In this video, we're looking at Ray Dalio's All-Weather Portfolio. We're going to look at how good this particular investment portfolio is and how we can implement it ourselves to use as our own portfolio if we wanted to. I'm hoping we can use this information to hopefully make better investment decisions and ideally get us closer to our goal of achieving financial freedom. Okay, so let's jump right into this thing. First, let's start with how good the All-Weather Portfolio really is. And to put it bluntly, it's really a fantastic portfolio. The goal of the All-Weather Portfolio is to consistently perform well no matter what the economy is doing or no matter what the stock market as a whole is doing. We're looking for consistent performance with limited downside, hence the name All-Weather. The theory is that no matter what the economy does, well, the All-Weather Fund will continue to plug right along with minimal downside risk. And now that's not to say that they never have down years. They do. But from what I've seen of their performance, about 85% of the years, they have positive returns. And in the years that they're down, well, the all-weather portfolio tends to be down very little, certainly very little compared to the overall stock market. Okay, so let's just say it's a good portfolio. Now our question is, what makes this portfolio different and how can we use it for ourselves? So let's start with how the portfolio is put together and what makes it so unique. The theory here is that there are two main economic factors that we should consider. First, overall economic growth, and second, inflation. And I'm sure we can all agree that these are two critical factors for us to consider. Our next question is, what is the market expecting? That's what this middle line represents, is market expectations for both growth and inflation. Okay, simple enough. Now it's possible that growth and inflation is either rising faster than expected, or perhaps it's falling faster than expected. And the theory is, well, maybe it's not a theory since Ray Dalio spent many years researching this, and then the many years since then running the actual all-weather portfolio. But either way, the theory is that some investments perform better during different economic situations. So essentially is what we end up with is 4 different portfolios that perform well or perform ideally during different economic time periods. So these are different asset classes that tend to do well in each of those given situations. And we may notice that nearly all of these different investment types or different asset classes are in 2 different boxes. So equities, which is the same thing as stocks, well, they perform best when the economy is growing better than expected and when inflation is lower than expected, which is fairly obvious. Commodities, on the other hand, well, they tend to do well also when rising growth is happening and also when rising inflation is happening. Now, I took this straight off of the Bridgewater website. So personally, I think that they could have simplified this just a little bit. I think we could have cleaned it up a little to make it a bit more understandable. For example, instead of equities, well, I think it's simpler just to say stocks. Those two are usually interchangeable, so I think it's just simpler to say stocks. Then IL bonds, this one might not be too obvious. IL, in this case, we're talking about inflation-linked bonds. Generally, the most popular version of that is something known as Treasury Inflation Protected Securities, or TIPS for short. Basically, these are bonds that pay more interest the higher inflation goes. So we would get rewarded with unexpectedly high inflation rates. Hence the reason that belongs up in that box. But either way, another example is nominal bonds. These are usually, in this case, talking about traditional government bonds. EM credit is just short for emerging market credit. Basically, they're talking about debt or bonds coming out of the emerging markets, usually emerging market government bonds. But hopefully this is a bit clearer and it's a bit easier to understand what we're looking at from a broader perspective. Something like commodities, well, it might not be obvious, but we're talking about things like gold or oil and gas, things along those lines. And then corporate credit here, well, this is the only one that Ray Dalio only lists in one box. So when I read Ray Dalio's paper on how they created the all-weather portfolio, well, he said that a corporate bond is simply a nominal bond plus a credit spread. A credit spread, just so we're all on the same page, it's based on the quality of the bond. So if 2 companies issue bonds with one company and both of them have 10 years until maturity, both bonds have 10 years to maturity. Well, if one company is a large blue chip company tons of revenue, tons of profit, tons of cash flow, and the other company is brand new with no track record, obviously the brand new company is going to pay a higher interest rate. The spread between their interest rate and the blue chip company's interest rate is known as the credit spread. Okay, simple enough. So what does all this mean? Well, here's the concept. Since no one can accurately predict where we're going to be at any given period of time, either for rising or falling growth and inflation, well, aren't we better off simply diversifying among each of these 4 different quadrants, or call them 4 different portfolios? And in theory, if we were to diversify equally among each of the different portfolios, let's say 25% in each of the individual portfolios, well, if we do that, aren't we going to have, in theory, better performance? But here's where Ray Dalio and the All-Weather Portfolio take this concept of diversification to the next level. So, to illustrate, let's imagine, and this is key, this is the important part of why this portfolio works as well as it does, and it has worked as well as it has. So just to simplify it a bit, let's imagine that we have 2 asset classes. Let's just say stocks and bonds. And again, we're going to keep it simple. We want to stay well diversified. So we're going to say 50% of the portfolio goes in stocks, the other 50% goes in bonds. And then we're going to look at the standard deviation of each of these individual asset classes. That is what this little red icon represents. This is called sigma. It's the Greek letter representing standard deviation. Standard deviation is the most popular way, it's the most common way for investors to measure risk. And basically, standard deviation looks at how volatile the asset class is. So, historically speaking, and this is true, bonds have been about 25% as volatile as stocks have been. So stocks have been about 4 times more volatile than bonds, even more so if you're talking about government bonds. But just to roughly estimate it, and we'll use some example numbers, but conceptually these are about right. So we're going to say stocks have a standard deviation of 20 and bonds have a standard deviation of 5. The actual numbers that we're using here are somewhat less important. 20 and 5 there, how we came up with those numbers is somewhat less important. Then the key point for us to remember is that stocks are significantly more volatile than bonds, which I'm sure is quite obvious to many people. And that's probably obvious even if we don't know what the individual standard deviation numbers are. Okay, but either way, so let's imagine that the stock market has a bad month, a really bad month, and stocks crash. Well, or at least they have a giant pullback. Well, let's imagine that our stocks all of a sudden have a quick drop of, let's say, 8% over the course of a month, or over the course of a day or a week, whatever it is, doesn't matter. Stocks drop 8%. Hypothetically, bonds, our bond portfolio, our bond piece of the portfolio, is up 2%. Now, I want to be clear that I am way oversimplifying how this works. I'm not taking into any of the other important factors, things like correlation or anything along those lines. I'm just trying to illustrate the fact that, perhaps if stocks are down 8%, maybe bonds are down 2%, or stocks are up 8, maybe bonds are up 2, or some variation of that. There's a lot of factors to it, but just to oversimplify the example, we're going to say that stocks are down 8, bonds are up 2, which is very possible that as stocks begin to crash, well, people retreat they have a flight to safety and they head into bonds. So you're going to see possibly some increase in bond prices. Okay, but now here's the important part. Don't forget, we are equally weighted. We own 50% stocks and 50% bonds. But because stocks are so much more volatile than bonds, well, the movement of the stocks is ultimately guiding mostly what happens to our portfolio. So what happens in stocks ends up sort of whiplashing around our overall portfolio. So in this example where stocks are down 8% and bonds are up 2%, well, it's not like we broke even. It's not even like we're still fairly far down, even though our portfolio is 50-50 weighted. Now, our real question is, how could we have made this portfolio that we would not have been hurt nearly as much by the impact of stocks? Well, using this very same example, what if we didn't have 50% stocks and 50% bonds? Because stocks are 4 times more volatile than bonds, because stocks are 4 times more volatile than bonds, shouldn't we hold 4 times more bonds? So if we had 80% bonds and 20% stocks. Well, just like that, now our standard deviation was 5. We have 4 different units of that. So now essentially we have an equal standard deviation. Now we are weighting our portfolio by risk, not by asset class. So going back to our all-weather portfolio here, well, this is exactly what Ray Dalio did. When we said that there's 25% in each portfolio, well, that is 25% of the portfolio's risk. So in theory, each of the portfolios are adjusted. It is not 25% in each of these asset classes. It is 25% of their contribution to the total risk of the portfolio. This makes the downside much more minimal and the returns much more consistent. Now, as far as how we as individuals can implement this type of strategy, given that this portfolio, this fund that Ray Dalio runs is a hedge fund and most of us cannot invest in it, well, Ray Dalio has teamed up with Tony Robbins to talk about how we could create this type of portfolio in a simplified manner. Okay, so to build this portfolio using nothing but ETFs, we're going to break our portfolio into 3 main sections. Our first section, this is the risk-weighted portfolio for our own all-weather portfolio. Our first section is stocks. That's going to be 30% of the portfolio. And we can see that with that, we're going to use the Vanguard Total Market ETF, ticker symbol VTI. Okay, then moving over to bonds. Our first section is 40% long-term bonds. So that 40% is going to be in the iShares Treasury Bond ETF, ticker symbol TLT. These are long-term bonds. And then 15% is medium-term bonds. For that, we're going to use the iShares 3 to 7 year Treasury Bond ETF, ticker symbol IEI. Okay, now moving over to commodities. Our first commodities holdings, it represents about 7.5% of the total portfolio. For that, we're going to use the iShares Commodity Index, ticker symbol GSG. And then finally, we have gold as our final piece of the portfolio. That we have another 7.5%. Now, most places that I found talking about this, most websites that I found talking about it, recommend using GLD. That's a gold ETF. But I happen to know that BAR is the exact same thing. That's a Granite Shares ETF. I've talked about that before. It is also a gold ETF, just like GLD, but they charge a smaller fee than GLD does. And since we're getting the exact same thing, I personally think BAR makes more sense. Now, this portfolio represents the risk-weighted portfolio that the all-weather portfolio essentially is doing. Now, I know this is counterintuitive. It is counterintuitive to me with only 30% in stocks, and stocks tend to be a much sexier investment than bonds are. But if we're looking for stability, if we're looking for reliability, this can be a fantastic type of portfolio to get us there. So if anybody knows of any other ETFs that could replace one of these ETFs that offer us the broad exposure that these ETFs are trying to give us, but hopefully they charge a lower fee, please let us all know in the comments below, because that could be very useful for everybody. Now, perhaps if this strategy is a bit too conservative, or maybe this is only going to be a piece of our overall portfolio, I actually did another video on another strategy that does quite well called the Dogs of the Dow. And basically, it's a dividend-based strategy that also has a track record of performing very well. So if you're curious, I made a video on that one. Perhaps that could be a good next video for you to watch. I got a link there. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.